I've reflected sometimes and thought, how did I not learn this in high school? We spent so much time,
This is
figuring
the
out
math they should be teaching in high school, right?
sine and cosine. And I don't even remember what that's for anymore. But a financial calculator, that's practical math that, everybody uses. Everyone is going to have a loan at some point, and it would be great for everyone to know how to use a financial calculator.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 276. My guest today is known to the world as the Canadian Note Guy. After running several businesses, including fix and flip real estate, he discovered notes in 2009 and has since become an industry leader in the private investment sector. His company is Earnest Inc, where he actively manages assets with a focus on non-performing first lien mortgages and contract for deeds in the United States. Nathan's specialties include raising private capital, analyzing assets, and developing systems and strategies to accommodate an ever-changing market. He successfully bought and sold hundreds of loans and properties. Nate, welcome to the show.
Thank you so much for having me.
Why don't we start with you just telling us a little bit about your background? I know you're the Canadian Note Guy, so
yeah.
What led you to start investing in real estate notes here in the United States while being in Canada?
It's so funny, like so many things in life, kind of by accident. And a happy accident, thank goodness. But it was a friend of mine who's also from Canada had moved down to the United States and met some people down there. This is back in 2007. And a group of investors in California had purchased a portfolio of properties, mostly centered in the Midwest, but kind of spread out all over the place. By the fall of 2008, everything had gone completely not according to plan, and they were kind of panicking, and they gave us kind of carte blanche and said, we know we're in trouble. We can't give you any operating budget. Do whatever you can. So a couple of Canadians, seller finance is really unusual in Canada. It's not completely unheard of, but almost. And so we thought we'd kind of come up with this idea of selling on terms. We thought we were these brilliant, inventors of this selling system. Come to find out, of course, that it's much more common than we ever thought. But that was kind of our way out of dealing with all these properties, was to sell them with seller financing. We didn't have an operating budget, so we weren't able to go and fix properties or anything like that. So we'd sell them as is, and people would start working on them and making monthly payments. And that just kind of opened a whole new world. I was actually doing some internet research and found some other people that were, describing what we were doing. And I thought, oh my goodness, other people do this too. And it just kind of went from there. I started going to conferences in 2010, probably. Started hearing about this non-performing thing. I thought I'd give it, actually it was 2008. And then in 2010 is when I started, that was my first non-performing note purchase. And I was awfully nervous about it and not quite sure how it was going to work, but it did. And I thought, man, this is quite amazing. It was quite an eye-opening experience to kind of get into it. And it's just kind of blossomed from there. And it's been a great ride and certainly a learning experience.
Now, we've talked a lot about notes, both performing and non-performing on the show. But for our listeners who haven't heard all those episodes, can you just give us real basic, in a nutshell, what are notes? What are you talking about? And also, I'm curious, when you first started creating those notes in 2008, you were basically creating seller financing, right?
Right. Yeah.
So just give us the nutshell explanation of notes.
When we're talking about notes, we're talking about mortgage notes. So any kind of an IOU is a note, and a mortgage is a perfect example of that. So you as the property owner own the property, but then you're borrowing money from the bank to be able to make that purchase, and you're making monthly payments. When it becomes non-performing is when you haven't made at least 3 consecutive payments. Where you've missed 3 payments in a row, then it's technically termed non-performing. The ones that I purchase are typically a lot more delinquent than just 3 months. Usually they're a couple of years where people haven't made payments for quite some time. So banks are eager and willing to just sell them off at, in the olden days, it was whatever they could get for them. They've since figured out that there's actually some profit to be made from this, or at least, much more money than they were letting them go for back in 2010. But they will sell them off to allow themselves to lend money to people who are going to pay, since that's their income stream. And that's kind of where I come in. So I come in as a non-bank lender, somebody who can be a whole lot more flexible than a bank. So as my role in that is talking with borrowers, I negotiate different payment plans. We figure out what works and what doesn't work. And like I say, I can be a whole lot more flexible than a bank. So it feels good to be able to help a lot of people out. And then on the flip side of that, oftentimes I will buy loans where the property is vacant. And in that case, really almost my only option, there are a few others, but one of my only options there is to do a foreclosure. So I'll foreclose on the property so that I take ownership of the house, and then I can sell that, rent that, flip it out, whatever I want to do. Usually I just wholesale it out. It's a local investor who's going to do all the rehab work and all that kind of thing.
So the notes that you created, did you create mortgages that are like Fannie Mae compliant, Dodd-Frank compliant, or do you create contracts for deeds or land contracts? I'm curious what you like, which of those you prefer. And if you could also explain the difference between them, that would be great.
Sure, you bet. So way back when, in 2010, when we started doing our thing, and when we were working with that original portfolio in 2008 and 9, it was in the Midwest, Ohio, Michigan, Indiana. They call it a land contract. It's the same thing as a contract for deed, just a different name. And then there's different names in various states. It can be called a bond for deed. It can be called agreement for deed. There's all kind of names, but really, essentially, it's the same thing. And what it means is, me as the lender, I actually own the property. Title is in my name or my company's name. And the person living in the house, it's kind of like a rent to own, where they're making monthly payments. The difference is they're making the payments with principal and interest as if it was a mortgage. So they're paying that principal and interest payment. Once they fulfill the terms of the contract, then ownership actually transfers over to them. So the reason I like that, and way back when, there was no Dodd-Frank. That was pre-Dodd-Frank, and then that came in while we were doing what we're doing. And I actually had to take a pause from actually creating those for a little while, because I wasn't a licensed originator, and at that time there were no licensed originators. We approached several brokers and different people that we thought would be in for this, and really nobody had any idea what we were talking about. It was a brand new regulation and brand new thing. Nowadays there are several loan originators that you can go to get everything all compliant and everything else, but back then that didn't even exist.
So explain what Dodd-Frank was for our listeners who don't remember that or aren't aware of it. What did Dodd-Frank, where did it come from, and what did it mean to you as a note investor?
So Dodd-Frank, in the investing world, it's somewhat controversial, only because it introduces regulations that didn't used to be there, and that can be annoying and that can be frustrating sometimes. But essentially, what it is it's things that are put in place to help protect the borrower, which makes a lot of sense. And it's simple things like making sure that they have enough income to be able to make the payments. Like, that's a standard thing, and that should be, something that should be in place. But previously, it wasn't. So making sure that they've got employment, making sure they've got enough income to pay for their monthly payments on the house. Essentially, really, that's the bottom line of it, is just making sure that they're able to make payments. I had to actually stop because I couldn't do it with the correct stamp of approval.
Okay. So because you weren't, I know a lot at that point, a lot of people weren't really sure how the Dodd-Frank rules applied and whether they'd be running afoul of them.
Right.
Do Dodd-Frank rules only apply to qualifying mortgages, or do they also apply to land contracts and contract for deeds?
They do. They apply for land contracts and contracts for deed. And again, that was something early on that it was kind of a gray area and nobody was really sure. But in the end, yes, it does. It does apply for land contracts and contracts for deed.
Okay.
So while everyone else was kind of catching up, we kind of took a pause from that and just waited until their license originators existed and we could go back to originating.
Yeah, because in order to create those types of loans, it had to be created by a mortgage loan originator. Is that the case? And is that still the case essentially?
It is, yes.
Does that add an extra layer of cost to the process, or do you have that pretty much figured out?
It's a small cost. The one that I use, he charges $500. I think it is $500 or $600, something like that. And there's different schools of thought on that. I don't usually charge that back to the borrower. A lot of people do, and that's whatever. To me, it's $500. It's not a huge deal. I'll cover that just to help everyone get started and get the ball rolling.
So give us some examples. I'd love to hear some stories from your experience of how you've created notes, invested in notes, and either profited from them and likewise lost money on them as well.
The best ones are when I'm able to talk to the borrower and we're able to work something out. And you know what? 90% of the time when we are able to start a conversation, we're able to come up with some kind of an agreement on payment terms, and it's really the best situation for everyone. And not even just in a moral standpoint, but actually financially, it's actually the best situation for me as well. So I'm extra motivated, not even just to try to help somebody out, but really and truly, bottom line, it's better for my business. So it's really the best situation.
How much might you pick up an asset for, and what would the terms be, and how would you work that out and make a profit in that situation?
It's so much fun when we get into conversations with borrowers because the sky's the limit. They may have $10,000, $20,000 in arrears, and we can put that on the end of the loan. We can put part of it on the end of the loan. They can make a partial payment up front. We can forgive part of it. We can split it up over monthly payments if that helps. I mean, there's so many things. That's just the arrears. And then we can start talking about changing the interest rate or the length of the loan or the payment amount. And I mean, there's really so many different ways that we can work it that it really turns into a real win-win for everybody. So it's really satisfying to be able to put that kind of thing together.
So give us a specific example of that.
Here's one. I've got one that I think I bought the loan just last October, so just a few months ago. And it's down in Texas, in El Paso. And the borrower has been there for some time. And it's a common situation where she's just missed every once in a while and just hasn't really gotten caught up. And then on top of that, just the last few months has been particularly difficult with pandemic, everything going on. So she's ended up being something like 9 or 12 months behind, something like that, which in my world is not insurmountable. Less than a year, that's a pretty easy fix. More than that, then we got to get a little more creative. But less than a year, that's nothing. We can work that out, no problem. So the fun part of all this is she's Spanish and speaks Spanish, and I don't. So we've been doing a lot with Google Translate, and so far it's actually working out okay. So for example, it was something like $10,000 in arrears, and we worked out that she could pay half of it up front, and then we split up another, I think, $2,500 to be paid in monthly payments along with her regular payment. So she's got a higher monthly payment for the next 12 months, and then it goes back down to her regular payment. And then that last $2,500, we'll just say, as long as the terms are all met, then that's fine. We don't even have to worry about that. We can forgive that portion. And so for me, that totally works. I get a kind of a bonus up front. I get higher monthly payments for the next 12 months. And then the regular payment is also just fine. So that completely works for me. And then on her side, that gets her completely caught up. And she's back into, good standing. So it's a great win-win.
What was the unpaid balance on that note when you bought it, and the interest rate, and what did you pay for it?
So the unpaid balance would have been around $40,000.
$40,000, including the $20,000 in arrears?
No. And then that was just the unpaid balance.
An additional $20,000 in arrears.
Right. So then she's got quite a big pile there that's sitting over her head that nobody's got $20,000 sitting around. Certainly not. The
longer she goes without paying, the deeper the hole she's finding herself in.
Yeah, exactly.
Which is why it's lucky that you come along and buy that note.
Yeah.
So if it was $40,000 plus another $20,000, and Gene, my partner, always calls that the coupon. Is that what you call it as well?
That's I don't usually use that term, but yes, that's awesome. That's a good one.
What do you use? What do you call it? That extra 20,000?
I call it the arrears.
Just the arrears.
Yeah.
So, okay. So really there's $60,000 there, but it's non-performing for less than a year. What did you pay for that?
I paid about $25,000 for it.
And there's about $60,000 owed altogether.
Right.
What was the interest rate on that?
Probably around 8 or 9%.
When you buy it at $25,000, obviously that 8% that she's paying is going to be a lot more when you receive it.
Right.
You bought that note at a discount.
Right. Exactly.
Did you run calculations on that to see what that real return would be for you?
I could do it right now. Sure. Yeah. So my yield on that, and yield is a little bit different than an ROI because yield is over the lifetime of the loan. So in this case, there's about 135 payments left. So it's more than 10 years left in the loan. But if we didn't even talk about the arrears, if all I was doing was collecting, I think the payment's about $450 a month. If all I did was collect that for the next 135 payments, my yield on that is 19%.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
Is yield, when you calculate that, is that basically your interest income?
Yes. Yeah.
So not including the principal, that doesn't include principal pay down because she's also paying down principal in her monthly payments.
That includes both, actually. So that's as she pays it down over the next 135 months, my annualized return would be 19%.
Does that include principal pay down on the $25,000 that you paid for it? Or is that above and beyond the $25,000 that you paid for it?
Well, my $25,000, it doesn't affect her. Like she's responsible for the $40,000 plus the arrears. Mm-hmm. So she pays that down. I happen to buy it on sale. So because I got it on sale, I end up getting a much better return than the 8%.
I'm real curious. You were doing some calculations there. Do you have a special mortgage calculator that does that?
Yes, actually, there is the 10B2 calculator, HP 10B2, and I actually have it as an app, and I use it a lot, almost every day, sometimes multiple times a day, depending on the situation and what I'm working on. I've got it on this phone. I've got the app on my computer, so I can pull it up on my computer, and it's just always handy because loan calculations are different than you're not going to be able to use a scientific calculator to get that done. You needed a loan calculator.
What's the key data points that you need in order to calculate your yield on investment?
Right. So there are 5 different inputs that you need on that. So the one is the number of months left in the loan, or however many months are in the loan, the interest rate, and the interest rate or yield. It's essentially the same thing.
A lot of times you're solving for that interest rate, right? Because
Right.
you don't quite know what that yield is until you plug in the other parameters.
Right. And that we're always trying to solve for one, whatever one that is. And we can work it around to figure out which one that we're working.
So you've got the number of payments left, the interest rate or yield. What else?
We've got present value. So whatever the unpaid balance is, in most cases, would be what the present value is. And then the monthly payment amount.
Would that include the arrears as well, or is that just the unpaid balance on the mortgage?
If the arrears was set up to be paid monthly as well, then yes, you would include that. So it kind of depends on how you set that up.
But if you don't set it up, it's still owed,
Yes.
but it's kind of outside your calculation. So it's really bonus money if you ever get paid that amount.
Yeah, exactly.
So we've got the present value, which is basically the amount owed.
Yeah. And then you've got the monthly payment amount and then future value. In most of our calculations, we're running this out the life of the loan. So the future value is going to be 0. And then you're working with the other 4 inputs and you're solving for 1. So sometimes I'll say, okay, the borrower can pay $500 a month. So I'll plug that in. I want to amortize this over 20 years. So I'll put in 240 months. I know the present value is going to be, the amount of the loan is for $50,000. And then I will solve for the interest rate and see what the interest rate comes up as. Or I can turn that around and say, okay, so I want the interest rate at 9%. I want the present value, the loan amount at $50,000 over 20 years. And then I'll solve for the payment and figure out what the payment amount would be. So it just kind of depends on what you're looking for and which one you're trying to figure it out at the time. But you're always just solving for one of those.
Thank you for taking us through the math on that. I always say this and believe this, that if you can understand the math as it applies to these different asset classes, then you can really make a lot of money.
Absolutely. And it's so interesting. I've reflected sometimes and thought about why how did I not learn this in high school? We spent so much time,
this is the math they should be teaching in high school, right?
Sine and cosine. And I don't even remember what that's for anymore, but a financial calculator, that's practical math that, everybody uses. Everyone is going to have a loan at some point, and it would be great for everyone to know how to use a financial calculator and work it out.
Absolutely. And the calculator you're using is different from a typical mortgage calculator that will give you 30-year amortization, this interest rate. That's a different calculator, which is important to understand as well. But you've got one that applies to people who actually invest in notes.
Right. And then from this calculator, actually, I can pull up an amortization chart. So I can that's the one I'll usually do on my computer. So I save it to my computer and I can send that to the borrower and say, so here's your chart. This is what the payments will look like over the life of the loan. So
the app allows you to get to that amortization?
Right.
Tell us again what that is, what you're using there.
Mine, the developer, actually, I'll plug them. It's In a Day is the developer, and it's just called 10BII.
When you're looking at pools or one-off type assets to buy, are you always running it through your calculator?
Yes and no. So what I've got is a spreadsheet that has the calculations embedded into it. And then I have a number of different scenarios. So when I'm purchasing a loan, it's really hard to say what direction it's going to go, and it's sometimes kind of funny the way it'll go. Where I buy one where I'm sure it's just going to be a foreclosure. From what I can tell, the property's vacant, and we're just going to foreclose, take back, and resell it to a local investor. And then it's happened more than once where somebody is living there, and it was just we're doing what we can to observe from the outside. So I had a local realtor go by, and from what they could tell, it looked vacant. And then we find out that no, actually it's not. Somebody was living there, or in one case, it was, I think, their second home. So there was nobody technically living there at the time, but it's not one that they had abandoned. It was just they were between renters. And so that was another situation. So I ended up going where I thought it was going to be a foreclosure, and we ended up making some kind of a modification on their loan, and they're able to start making payments again. And then vice versa, where I'm sure, they've been non-paying for 6 months. And usually in that case, they're going to start making payments again, and we'll be able to have a reperforming loan. And then the complete opposite happens, where it's totally vacant, and for whatever reason, we couldn't tell that from the outside, and we figure out that it's a house we're actually going to take back and resell.
To summarize, it seems like
Sure.
Sometimes whatever calculations you might do go out the window because the people who own the property or might live there throw you a curveball, and you end up working out something new.
Yeah, and so I've got my spreadsheet before I ever purchase anything, and I'll plug in the numbers, and I've got different columns for the different, general scenarios that could happen, and I base it on the lowest of those scenarios. So I might think that it's going to be a foreclosure, but just in case, I'll run it through and see what it would be if they started making payments again. What would be my end number in that case, roughly. And I'll base my bid on whatever's lowest, just because there's no way of really knowing for sure what's going to happen with this.
So what are the parameters you typically look for? In yield, if you were to sell it and get the cash value, what do you typically want to see?
I'm a little bit of a different note investor. I consider myself running a note business more than a note investor. I have my own notes for myself, and in that case, I'm an investor. But my business is to buy and then resell. So I'll buy it as a non-performer and work it through. And sometimes that means I've got a reperformer on my hands that I'm going to resell as a performing loan. And sometimes that means I'm taking back a property and then I'm going to sell it. Sometimes that means I take back a property and it makes most sense to rent it before I sell it. And so there's all kinds of different scenarios. But I'm always buying with the intention of reselling. So that being said, a big part of what I'm looking at is there's a very good chance that I'm going to be taking back a property. So because I'm in first lien position or contract for deed, I'm quite interested in the property itself. So I do some fairly extensive research on the property, trying to determine a value as best we can from the outside of the property before we get access to the inside. And then truth be told, that those are the ones, if there were a situation where it's going to backfire and it's not going to go as well as planned, is when I take back a property. We'll take it back and we get inside and it is just World War III just happened in this house, and there's mold on the walls and broken this and cracked that. And those are the nightmare scenarios. But
well, tell us about one of those nightmare scenarios. Give us a real world example of when that happened,
sure,
and whether you were still able to make money off of it or whether you had to take a loss.
So I've got one right now that I'm working on. It's one that I bought for myself in Virginia, and vacant property. Let's see if I've got numbers on it right here on my other screen. So I bought it for $15,000. So not a huge expense on my part. We figured the property value is around 45. So a pretty good deal on that. And then I anticipated finish a foreclosure and then reselling it. So the foreclosure went just fine. Sure enough, no objections. Nobody came out of the woodwork or anything, and so that's fine. The borrower had passed away, and so that's, it is what it is, and that's how we had to deal with this one. I had it under contract. It was actually supposed to close last week. And my buyer, he's actually a real estate agent in Virginia as well. And he got in, and he was getting bank financing to finance the deal. And they went downstairs, and the walls of the foundation were completely bowed in. And there were some major foundation issues that, we had no way of knowing before we bought the loan. So we're working on that. I think I will still make money on that. I'm not too concerned about it, but my return won't be as good as what I was hoping.
How is it you'll still make money on that? Because most people would consider that a disaster and be losing sleep for a week over it. How are you going to make money? How are you going to pull that out?
Just because even with the repairs that are needed, and it's not a small repair, we're talking, we got a quote on it for $20,000 to get that all fixed. So it's not small. I had it under contract for a deal with this realtor for $40,000, and I was only into it for $15,000. So I stood to make quite a bit on that. And now with those repairs, I think we'll still be able to sell it for 30 to 35. And, time will tell.
After you make the repairs or before you make the repairs?
Before. I won't do the repairs. I'm not local. I don't want to have to not be there when those kind of repairs are happening. So I'll sell it off as is. And I think we'll still be able to sell it for 30 or 35,000. So I won't lose anything. It just won't be the big payday like I was hoping for.
Because you're buying at such a discount,
right?
You have a wide cushion for these types of setbacks.
Yeah.
Well, it sounds like some of the properties you take back through foreclosure. Talk about that process. Give us an example of how that works for you, and whether or not that's been a problem during this pandemic.
Typically, it's not a big deal. It's state by state, and I prefer shorter foreclosure timelines. So a lot of the New England states, New York, New Jersey, Pennsylvania, they've got really long foreclosure timelines. So I tend to stay away from those areas, just because of time. It's not necessarily more expensive or more difficult. It's just really time consuming. And I don't want to have my money sitting there doing nothing for that long. So I will buy in, even Ohio is longer, but good enough. And Indiana, same thing. It's longer, but good enough. Michigan's faster. Texas is faster. It really just depends state by state. And, I go to different conferences and things. There's always lawyers there trying to pitch their themselves and their business. And that's great. I get to know a lot of them, and lawyers are actually a lot more fun than I thought they would be. They're much more personable than the image I had in my head. But they're good at what they do, and they get the job done. And it works pretty well.
Give us an example of a recent property you took through foreclosure.
One that actually we just finished in Mississippi. I forget the town name, but anyway, in Mississippi. And we started, I want to say it was probably last September, October. So it's been 4 or 5 months. So not bad as far as foreclosure timelines go. And it's really mostly hands off for me.
You just have an attorney in the area take care of it for you?
Yeah. I'll reach out to them and say, hey, I've got this one. Again, it was deceased borrowers. So I said, here's the situation. Here's all the paperwork to go with it, showing, the terms of the loan and everything that's involved in that, what the payoff was when, at this moment. They usually send me something to sign, and I'll sign it and send it back. But really, it's fairly painless. And then I'll check in with them every few weeks and just say, hey, how's this coming? And they'll let me know if there's any problems, anything that I need to be aware of. they need to file an extra. I had one this morning where they had to file something extra with the court in Arizona because the package they were sending in was 40 pages and the county had a limit of 25. So they had to file something saying that it was going to be more pages than the 25, just letting me know it's not going to slow anything down. It's not going to really make a difference. They just were letting me know. And I said, okay, great. Thanks. And really that's it. Every state again is a little bit different in the way they handle it and their system, whether it's a judicial state or non-judicial, and it's a different process depending on which state you're in, and it kind of depends on where you're at. But again, all in all, it's fairly painless. I check in with the lawyers; they know what they're doing, and they'll tell me if they need anything, if they need me to sign something, or send them an updated payoff statement, something like that. But I find for me, my main job in that case is just to kind of follow up, and make sure that I don't get put to the bottom of the pile by accident.
Yeah, don't just assume the attorneys are taking care of your business. You have to stay on top.
They're people like everyone else. They've got lots of things going on. So I'm the little bug in their ear. Then COVID.
Yeah. Oh, yeah. That's the big one. It's been very difficult to foreclose.
It has been.
So
Yeah.
how is that affecting your business?
It's not been a huge impact. I think partially because I've got enough other loans that not everything that I have is in foreclosure or stalled in foreclosure, as the case might be. So it's been fine. Somewhat annoying and somewhat frustrating. I've got one in San Antonio. It was supposed to go to foreclosure last March. And then, of course, everything shut down. And then it's just been almost, in most counties, it's on a monthly basis. They'll extend out the moratorium for one more month, and then they'll extend it for another month, and then they'll extend it for another month. So this one in San Antonio has been sitting there. It's vacant property. I've got my realtor making sure that nobody's breaking in and things like that. But otherwise, it's just sitting there. And for me, that's a little bit frustrating because to me, there's no reason for that one not to go forward. If it's a vacant property and nobody's there, let's just finish it, and not let it become a drag on the system, on the neighborhood. There's really no reason for that, but that's another story.
Yeah, that argument doesn't really fly
No.
right now.
No.
So Nate, as we wrap it up, I'd love it if you could give our listeners any advice, those who want to invest in notes or are thinking of going down the same road as you. What would you say to them?
A lot of people that get into notes come from a real estate background, including myself. The thing that I want people to understand is that this is real estate related, but it's not real estate. So just because you have flipped houses or just because you've owned properties, just because you've had rentals, that it's not the same thing. And so my biggest advice would be to get some kind of education. And that's not even a plug for myself. I don't even offer education, but get some kind of education because it's different enough that if you go in thinking that you know what you're doing, you don't, and you can get yourself into some trouble. So get some kind of education and just realize that it's not the same as real estate. It's related, but it's not the same thing.
Good advice. How would people get a hold of you or find out more about you?
Call me anytime. I could talk about notes all day long. So give me a call. My number, 312-860-3747, or send me an email, nathan@canadiannoteguy.com, or go check out my website, canadiannoteguy.com. And let me know where you're at and what I can do to help, because it's a really good, tight community, and everyone helps each other, and including me. I like to help others that are getting started or who've been in it for a long time. We talk all the time.
Thank you, Nate. I've enjoyed talking notes with you.
Yeah.
You're the Canadian Note Guy, and my partner Gene talks about you all the time.
Yeah.
I know you as a Canadian Note Guy, and I'm sure a lot of other people do. Thanks for explaining the differences between mortgages, contract for deeds, land contracts, taking us through the math and the calculator that you use or the app that you use, and just giving some great advice for note investors on how to be successful in this business. It's been a pleasure talking with you. Thank you.
My pleasure. Thank you.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.